Taiwan is down around 0.2%.
Many participants stress the need for the Fed to keep tightening, quote, even as the labor market slowed.
7.4 is the number compared to CNBC-TV18 and everybody's poll of 7.3%. The sad part is that the upside has come largely from food.
The start, 25 points lower is what we have on the Nifty at this point in time.
PSU banks, they do well, okay, when the overall credit growth is stronger because their expenses and their costs, they don't really rise as much. So there is a margin improvement what we see.
The company's Q3 guidance at 0.5 to 2% revenue growth has come in softer than street expectations.
We've been growing, as you know, pretty strongly in the quarter two, 4.1% after, and an acceleration after quarter one.
At this point in time, we have the Bank Nifty, which is down over a whopping 650 odd points.
It's a one-time grant that has been given to the oil marketing companies from the government to the tune of 22,000 crore rupees.
Incremental loans in H1 FY23 amounted to rupees 7.4 lakh crore.
It is sitting with cuts of 115 points. That is the Nifty.
Well, that was the day so far. Hello and welcome to a fresh new edition of Closing Bell. I'm Prashant. With me, my colleagues Rima here in the studios and Nigel joining in from the newsroom floor. Guys, hi.
Hi.
Good afternoon. I mean, not very much going on, is there? It would seem like it is, but for many sessions now, it's all been about just choppiness, but not really picking a direction one way or the other, either up or down. The low today is 956 or so, which is pretty close to the low yesterday and the low day before yesterday as well. This needs to hold. Bulls to hope that maybe there is more without first there being a big significant downside. In any case, this seems like a waiting game. And what are we waiting for? We're waiting for, of course, the big inflation number out of the US. All sectoral indices, at least the last time I checked, in the negative, and you've got PSU banks, private banks selling off more. So day before yesterday, PSU private banks sold off. Yesterday they came back. Today they're down again. IT, for example, in the morning IT stocks were looking up. Today, they significantly sold off through the course of the day, ending lower. Yesterday it was the opposite. So across sectors, there isn't very much to go with in terms of a trend. Even the US CPI number, which we will get later today, markets are, of course, holding on for that before they decide what to do. But remember this, unless and until the CPI number is a very clear-cut big beat or a big miss, people will still quibble. There are Fed speakers after this. Some will find this sort of hotter than expected. Somebody else will find that to have cooled off. So the immediate reaction post the CPI number, one way or the other, unless it's a clear-cut number, a miss or a beat, is likely to be faded. If it's up, maybe by close, things cool off. Maybe if there is a significant downtick, perhaps the market gets bought because the US, of course, has been selling off quite aggressively. So that's a brief point to be made. We're watching it, but will it really provide very significant cues? That depends on the extent of the beat, the clear-cut nature of the data point, which we will get later today. Rima, hi.
Hi, you almost get the sense that the markets are reluctant to go down, break that 200-day moving average decisively, conclusively. But at the same time, you get the sense that it's finding it very hard to climb up and sustain at these levels. It's a bit vary over the last few days, but the trading range has been held on to. And today, of course, is the weekly options expiry. So the last 1 hour is going to be very crucial. All said and done, with a cut of nearly about a third of a percentage point on the benchmark indices, once again, we're outperforming the Asian markets. A quick check on how Hang Seng and the Taiwanese markets closed up, and you would see deep gashes of nearly 2% coming through. And week to date as well, these markets are down close to about 7% Nigel. So all in all, the trading range is being held. The focus will be on earnings, and this is an outperformance versus the other markets.
Well, hi Prashant, hi Rima. There's that famous song by Guns N' Roses, right? Knocking on Heaven's Door. It seems that today we're knocking on support doors because the Nifty and the Nifty Bank, both those two, if you map the last few days, on the Nifty, 16,950, from there we've seen a bit of a bounce. On the Nifty Bank, 38,500. We've gone there numerous times in the last few days, and from both those two support levels, you're seeing a bit of a bounce. Now, it's quite interesting because, as you mentioned, today is the weekly expiry. And just till around 20-30 minutes ago, the call writing was being done at will. So the 17,100 call, 17,050 call, and the 17,000 call. The premium between all these three, the open interest build-up between all these three was close to 2.5 crore. Now, what was happening was that you were writing calls at wills, but suddenly you're seeing a bit of a bounce. On the downside, the 17,000 put, there's a good amount of open interest built up out there, and the premium was in that vicinity of around 30 to around 50 rupees odd. So that's telling you, at least in the near term, the bulls are counting on that 16,950 odd level holding out. Now, what's happened in the last 20 minutes or so, you pull up the Nifty intraday chart. I've seen a good bounce of close to around 50 points from the low point of the day. If we can sustain above this 17,050 odd mark, we could be bracing ourselves for a bit of a bounce. We're holding above that level, but if we can sustain above these levels, this is the one that I'm talking about, we're likely to see a bit of a squeeze because the call writing was happening at will. The market is net short as well. So we just need to hold above these levels. The 17,000 call writers will get into trouble. 17,050 call writers as well will get into trouble. And maybe we'll see a bit of a dash towards that 17,100 odd mark. We'll know all of that in the next 60 minutes odd. First up though, let's get you a quick a view on the markets. Mitesh Thakkar joins us. Hi Mitesh, how do you position yourself? If you were brave and you bought it around 16,950, you'll be quite happy. Do you think we've got a little bit more in terms of an up move?
Okay. Nigel, one confession, I think we didn't buy at 16,950. I think purely because, one, the structure is weak. But then you have the 200 average and that pivot of 16,950 has worked for 3 consecutive days. So I think wait for it to break, then I think you'll be more comfortable to take on a short position. Till then you'll have to patiently wait it out. So you can do a put spread or just wait for 16,950 on the spot to be taken out. As long as that is not breaking, we have even attempted some long positions on individual stocks. And I have 2 buy calls right now. HCL Tech, I think with the gap up is holding very nicely, so that could do well. That's a buy. Keep a stop just below levels of 966, 965 here and look for targets around 1,015, 1,020. And the other one which I have is Britannia. It's just turning the tide on the hourly and the 2-hourly chart. So this could be interesting for the next couple of days. Britannia is something which I would recommend buying. Keep a stop at about levels of 37.70 or just below that and look for targets around 38.45.
Okay, those were a few last hour trading strategies. Mitesh, we'll come back to you. Deven Chokshi is also with us. Deven, AB Money, it's a small company. It came out with numbers, but there is this big jump, 51% increase in the company's profitability, and the stock has surged. It's up close to about 11% on very large volumes. Do you look at it?
Yeah, Rima, I think haven't seen this particular company of late, so I think would refrain from putting comments across.
Yeah, but why don't you run us through what's happening to Wipro? I mean, it's down 7% now. I mean, it started about, 4% lower, weakened further, and pretty much the day's lowest point now. It's not as if it was sitting on a lot of gains coming into this earnings. So that makes it even more, worse.
And it's not that the valuations were at a premium or very expensive as well. But let me tell you what the street is disappointed with. One, as we said, the Q3 guidance has missed expectations, fairly modest for the December quarter. 2, the margin recovery from current levels is quite unclear. In Q2, the margin gains were just about 16 basis points. The management said Q3 margins will be similar to Q2, which means no more expansion. And the street has pushed forward its margin recovery targets. The company's medium-term guidance was that margins will go back to 17.5%. Maybe the street was anticipating that we'll get to that in FY24, but that has been pushed forward. And look at the way the margins of Wipro have come down. Its peak margins, were 21.5% post-COVID, which means it's fallen by nearly 650 basis points from, the post-COVID high level. So that's a very sharp decline, and there is no visibility on how you're going to get back. Forget to those 21.5%, but even the medium-term guidance of 17 to 17.5%. So that's a bit of a worry. Another point is the hiring has been fairly muted. Just pull up the hiring numbers for Wipro, stack it versus peers. Wipro this quarter has added about 605 people net. Right? Look at its last 4-quarter average. It was more than 12,000. Yes, you would say that the company invested in its people in advance demands, and which is why they've gone slow. But in a way, it also factors in the uncertainty in demand. Another indicator, the deal wins. Now, deal wins for TCS were flat on a quarter-on-quarter basis. For HCL Tech, they expanded 16% quarter-on-quarter. But for Wipro, they had a sharp fall of nearly 24%. So again, when you stack it versus the rest of the peers, on deal wins metric as well, it falls short. And finally, as I said, due to the miss on the Q3 guidance and the lack of visibility on margin recovery, brokerages have brought down their EPS estimate. Nomura by 3 to 5%, CLSA by 1 to 4%. Edelweiss, which was far more optimistic earlier today, Sandeep told us that his FY23 EPS has been lowered by nearly 8.5%. So that's a very sharp earnings downgrade that we've seen for Wipro. Kotak also says that they believe Wipro will underperform peers on the growth metric by 2 to 4% over the next 3 years. So which basically means growth underperformance and the fact that, it's a little uncertain in terms of, what the margin outlook is going to be.
Absolutely. Doing worse off, and I mean, if it's an 8% earnings downgrade, at the end of the day, stocks move on earnings surprises, up or down, and this is down. And the stock is reflecting that. Devin, any thoughts on Wipro? Thankfully, what we're seeing on Wipro is not being taken as a straight-off reflection of what is likely to happen with other IT companies as well. I mean, there is differentiation, as Rima just highlighted, even within the top IT companies.
Yes, Prashant. I think Wipro's particularly, the strategy, as we discussed even yesterday on your channel, I think the strategy of, growing the company inorganically through acquisitions, is proving to be more challenging, because those acquisitions that the company has done has actually, created, dent in the margin. Though on one side, it has possibly given the lift to the revenue, the margin dampening has happened due to this acquisition. And there is no clarity per se as far as, the improvement in the margin is concerned. So somewhere, in order to take care of the growth on the top line, probably the company has compromised on the margin. It's very clearly evident. And at the same time, this strategy will have to sustain, because organic growth, versus inorganic growth. In such situation, if a company like Wipro is trying to grow inorganically, it has to sustain for producing the numbers that we are all asking for. So vis-a-vis Wipro, currently, the better opportunity would stay with company like Infosys or company like TCS per se, or even in the mid-tier segments, the companies like Mindtree or L&T for information. Those LTIS, would be the right kind of a choice as one would like to look at.
You said you would go with TCS and Infi in the large cap space, not HCL Tech. HCL Tech's numbers were an all-round beat. There were no complaints. And plus, there is a valuation comfort with HCL Tech vis-a-vis TCS as well as Infi. Why would you not consider that?
No, I just mentioned these two names.
Okay.
HCL Tech definitely, improved, on the performance. And with the corrected strategy that they have brought in, quite possible that this performance would sustain over a period of time. From the guidance at least, it gives confidence that the performance which they reported, is likely to sustain going forward. Most importantly, the new order wins, which is very, very important according to me. And if that is growing, then possibly, the revenue and the profits will follow hereafter. So yes, certainly one could include HCL Tech in the ranks.
Okay, all right, got that, Devin. Stay with us. By the way, guys, just want to do a quick options check. The 17,050 call should come up for you on the screen. The open interest out there, the built-up was close to around 85 lakh shares. Now, suddenly, in fact, there is a sharp, quite a bit of shedding that we've seen. More than 10, 12 lakh shares have got shed on that front. So the 17,050 call should come up for you. The level that you're looking at now is around 17,075. Because they're writing the 17,050 call, and plus you add the premium, which is around 25 rupees odd. So keep an eye out on that 17,070, 17,075 odd mark. If we can breach that level, we could see a very, very sharp up move. So that's the level you're looking at. We're already holding above the 17,050 odd mark. Just thought we'll highlight that for our viewers. But Rima, coming back to you. It's all about IT, right? Infosys as well set to report numbers in the next 90 minutes or so. We'll also be watching out for that buyback. What do we expect?
Well, let me talk a bit about that buyback, right? Because that's where all the excitement is. Now, ICICI Securities has done some interesting analysis, and they have analyzed how the stock performance is prior to the company announcing a buyback and post. And they've covered all the large cap IT companies. And they're saying there is no clear relation between price gains and the buyback announcement as per their data and the analysis. So they're saying in the last 14 instances, and this covers not just Infy and TCS, but even the others like HCL Tech, Wipro, etc. In the last 14 instances, in the 11 out of the last 14 instances, the stocks have actually performed better in the 1 month prior to the buyback versus a month following the buyback. So let's get that data up for you on your screen. So now I've just taken TCS as well as Infosys. Now let's pull up TCS's data in terms of the buyback. These are the earnings estimate. Do we have the buyback data with us in terms of the stock? Okay, so let's, we'll come back and analyze that. Let me quickly run you through what the street is anticipating in terms of the earnings expectations. Well, a dollar revenue growth of about 3.1%, a constant currency revenue growth of closer to about 4.5%. Margins for Infosys are likely to see a very minor expansion, close to about 20.5%, and that's because of the residual impact of the wage hike. The key is going to be on their FY23 guidance. Do they upgrade it like HCL Tech? If they do, it will come in as a big positive surprise. Currently, the guidance is 14 to 16% on the top line and margins to be closer to the lower end of the 21 to 23%. Deven, would you expect any surprise on Infosys in terms of the earnings?
Well, I think more importantly, I think the earnings definitely would remain strong compared to the others. The important part would be, I think, how much execution I think they are indicating at. The current challenges possibly in the environment is largely, I think, limiting most of these companies to focus on the execution side of the story. Vis-a-vis every dollar of order win that they have, how much is the execution which is happening? I think that is a ratio that I think I would like to look at as far as I think the company's announcement is concerned. And more importantly, I think what is the quantum of deal that I think you are basically winning? Many times I think we look at the deal wins, but I think which side of the deal wins? I think whether it is in $1 billion, I think which is more important, or I think below $1 billion, I think deals I think which are more important. Sustainability over 5-7 years I think would mean a lot. I think as far as this particular deal wins are concerned. So these are some of the points I think definitely one would like to see. Of course, the company is retaining significant amount of cash in the balance sheet, and this buyback is definitely I think more than welcome at this point of time.
Okay. All right, Deven, I wanted to ask you about some of these metal stocks. Out of nowhere, you have these supply cuts that come about, and suddenly LME prices do a thing of their own. Now, aluminium prices overnight were up by, 5-6% approximately. That's because there were reports that suggested that the US could impose sanctions on Russia. And that would mean that 6-7% of the global supply goes out of the system. That's one of the key reasons why you have Hindalco, Nalco, and even Vedanta. Well, they're trading with some green. What's your take? I mean, realistically, I don't know whether or not this is possible, because in the last 1 year or so, US has taken a fair bit of these aluminium supplies. They tried this earlier in 2018, but in 2019, they called it quits. Do you think this time around they can push it through if yes, aluminium prices remain elevated and then maybe some of these stocks do well? Your take?
So, Nigel, I think this is extremely going to be challenging. On one side, I think we are seeing the slowdown conditions in the Western world. On the other side, I think a sharp fall in the prices have already happened as far as aluminium is concerned. And I think the important point is that I think going by the experience of crude oil, the US's strategy of sanctioning Russia is not working well at all. On the contrary, I think it is proving more beneficial to Russia than I think proving against it. So from a perspective of I think looking at this particular aspect, whether the sanction on aluminium or I think tariff hike for the aluminium could result into I think a dampening of the supply from Russia, I think the answer is clearly no. Even though I think they're one of the largest after China as far as supply of aluminium is concerned in the world market. So I think very difficult to take a call as far as I think the commodity price behavior is concerned. I would rather say that I think we should stay focused on Indian companies where the domestic demand scenario remains extremely promising and the kind of consumption levels are improving. From that perspective, Indian companies are relatively better placed. If the prices are firming up and if they end up I think getting higher amount of realization and profits, nothing like it. But I do not know whether it will sustain given the kind of reason under which it is operating.
For some stocks, I mean, this might as well be yesterday. It's a repeat performance, basically. Look at Mazgaon Dock. It's up 4%. Garden Reach Shipping, it's the same set, same trio. Garden Reach is up 4.33%. There's Mazgaon, Garden Reach, and Cochin Shipyard, 4.25%. four each yesterday, 4 each today. So that's quite something. Kalyan Jewelers is another one. We spoke with the management recently. A day ago, 5.5% higher, stocks at about 102 now, so it's moving up. And the other one which has done very well recently is Hbl Power. It's almost at about 120. It's having a pretty phenomenal month so far, and I think the last month also the stock's done very, very well. Devin, do you track this one, Hbl Power? Have coverage or not really?
Not really, Prashant. We don't have coverage on this stuff.
Okay, and these defense names, do you have coverage yet?
Yeah, I think so. We keep tracking them, and probably I think some of the companies look interesting. Even Mazgaon Dock that you mentioned, I think they are showing good amount of revenue visibility, around 25-30% kind of a revenue visibility. I think on the growth side is happening for these companies. The bigger challenge would be on maintaining and sustaining the margin front. I think some of these companies, which you would like to see, on one side, the demand scenario is significantly improving given the kind of government's focus on sourcing defense from India. And on the other side, I think many of the defense companies will have a challenge in form of maintaining the margin because government is a big buyer. And over there, I think the margins are unlikely to be on a higher side. So that would be, one challenge that one will have to feel through. But given the strong top line growth projection, I would think that many companies would relatively have better performance compared to their previous years. So wait and see. Of course, Mazgaon Dock remains, one of the promising one of the lot, along with companies like Solar Explosives, which have relatively higher amount of supply to the defense segment.
All right, noted that view, Devin. By the way, the Nifty, it did a nice move. It went towards that 17,080 odd, but it couldn't sustain at those levels. The intraday chart actually will tell you the picture. It's seeing a bit of selling from that top. So we can sustain about that level of around 17,075 that I was talking about. We'll be bracing ourselves for a bit of a bounce. For the time being, though, it's been met with a bit of a hurdle, and that's why we've come off 10 to around 15 points odd. It's going to be quite an exciting weekly expiry is, my reading of this one. For the time being, let's slip into a short break. You come back, Rajesh Kothari of Alpha Accurate will be joining in to discuss the road ahead for the markets as well as themes that he's positive on. Welcome back. You're tuned in to Closing Bell here on CNBC-TV18. Well, we've got a bit of a recovery from the day's low. We're up close to around 120 points odd. And in the last few minutes, a few stocks have moved around. So Tata Motors has seen a good recovery intraday. That chart should come up for you on the screen. Besides that, you have IndusInd Bank. Just take a look at that chart out there. The stock is moving high and moving higher very, very smoothly currently at the high point of the day as we speak. And throw in there a couple of other names. Bajaj, Finserv, well, that was trading in the red. Now that's fought back a goodish bit. And TCS from the IT pack. That was down, but just take a look at the intraday recovery. The stock is trading more or less flattish, and TCS has a relatively larger weight. In fact, it's moving to the green as well, so just keep an eye out on that stock. But Nimesh is standing by, and he's picked up an interesting note by Citi on cement stocks. Well, Nimesh, tell us, the street is buzzing around. They want to know more details. They have upgraded Ambuja Cements. Go ahead.
Oh, yes, Nigel. So it's a big report from Citigroup today, 86-page note, and they've made some big changes to the cement sector stocks as well. So the first is they've upgraded Ambuja Cement to a buy from sell, and they've raised the target price to 610 versus earlier of 340. They've downgraded JK Cement to sell now, and they've got the target price there to 2400. They've also downgraded Dalmia Bharat to neutral, and there they've got the target price to 1650. Now the top picks for Citigroup within the cement space remains ACC. There they've raised the target price to 2900. Ultratech Cement, Grasim, Nuvoco. The top sells are Shri Cement and Ramco Cement. So these are the few stock recommendations. Now coming to the sector per se, the key outline from Citigroup is one, they believe that the pricing will remain subdued despite significant scope for consolidation. They believe the nature of consolidation will be smaller players will be bought out by larger names, most likely by Adani Group. And Adani's ability to service debt at a reasonable EBITDA per ton may not encourage price hikes. So that's one bit. Second, moreover, they believe that Adani Group's ability to become the most efficient player by working out various cost levers will also mean that the focus will be on market share and not on pricing. So that's the second bit from that note. Interestingly, they've identified 84 million tons of acquirable assets, which potentially could be bought by larger players like Adani, and the names include the likes of India Cement. They have a 17 million ton capacity. Sanghi Cement, 6 million ton capacity. JK Lakshmi Cement, 14 million tons. There is Star Cement, 6 million. Heidelberg, close to 6.5 million, and Nuvoco close to 24 million. Remember, JP has already announced, selling the cement assets. It's included. That name is also included in the potential list. So, and they believe this list has largely been calculated on the basis of, balance sheet strengths, maybe a bit of foreign ownership, or for that matter, the succession worries as well. So that's what the city has identified, 84 million tons. But broadly, the key changes is they've upgraded Ambuja to buy and raise the target price there, and they've downgraded two stocks, which is JK Cement and Dalmia Bharat, on the back of big consolidation happening. But they do not expect massive price hikes going forward.
Okay, all right. Interesting note. Nimesh, thanks so much for joining in and giving us that law. Everyone on the street wanted to know the rationale. In fact, Nimesh has brought us just that. Well, Rajesh Kothari joins us as promised. Hi, Rajesh. Thanks so much for joining in. Well, before we talk about the various themes that we wanted to discuss, Rajesh, I wanted to ask you, what's your take on the cement space? Do you all have any kind of exposure out there? You heard what Nimesh had to say. Clearly, the street is baking in that there could be some bit of consolidation. Are you all playing that theme, or are you all staying away?
Well, I think, so primarily, broadly speaking, I agree with what Nimesh has just talked about. I think in cement industry, there are few advantages from here on. One is the raw material cost, which is coming down. Second is the energy cost, that is also coming down. So these two, which were the major issues in last, I would say, 8 to 12 months, they started coming to your favor. The volume growth, right now, the housing demand still remains strong. So we expect even volume growth to improve. The only challenge in cement industry was the pricing power, which was not demonstrated so well, if you ask my personal view, in last 3 to 7 to 9 years. And hopefully people believe that with such kind of acquisitions at such valuations, it brings some sanity in terms of minimum return on capital employed, which one needs to earn to make money in this industry. So I think that's basically the broad theme, if you ask my personal view, and one needs to play this theme very selectively because, as the new entrant is definitely has a more thing to chew on, definitely it may create some adverse impact on the existing companies' market share, as well as their profitability, and maybe to some extent the compression in valuations. So, that's how you need to play this theme.
Rajesh, afternoon. Everyone is looking inward because people are worried that the export-facing sectors and stocks may be under pressure. So it's best to play the domestic demand story. And in that, PLI scheme has emerged as a big winner. And this India, the government's flagship program of Make in India has recently completed 8 years. The PLI coverage has been expanded to so many sectors. A few of the stocks like Dixon Tech, etc., have now been well discovered. The stocks have already run up. Could you talk about some of these PLI beneficiaries which are still hidden? Not too many people know about it, but they're doing some great stuff.
Well, I would say, please let's not restrict to just PLI as a benefit, because I always believe that if any company is setting up plant or making investment just to get one benefit or tax benefit or PLI benefit, they are never a sustainable one, right? So what one needs to understand is that whether a company has a globally cost competitive business model or not. And with Europe plus one, we discussed last time, and that time I talked about that we are just working on that theme, and we did a little bit more work on that theme, that from China plus one, there is another opportunity called Europe plus one. And there are many companies, both multinationals having its subsidiaries in India. Number two, the Indian companies who already have the European customer base. And number three, the domestic companies, but who have a large economies of scale, and they aspire to be now the global players. So benefit will flow to these three buckets, So we have done a very detailed, exercise on this. And there are a number of sectors which will benefit from this theme. Capital goods, of course, going to be the one sector. Specialty chemical is going to be second sector. Very selective auto ancillaries will be the third important sector. And few, probably you can put everything is like others kind of thing. So these are the three major sectors. capital goods, specialty chemical, and auto ancillaries, which will benefit from this theme. And I think the trend has already started. Many of companies in our portfolio, they are seeing the increased traction from the parent company, particularly based from Europe. Many of our companies are also getting the higher offtake from their customers, particularly in specialty chemical. They are getting the incremental orders. They are also getting the companies, particularly who have a European approved facility, European regulator approved facilities. They are also benefiting in a big way. And I think the trend is just a beginning. And therefore, while we all discuss about the global and US Fed, inflation, and so many things, but the fact of the matter is there are companies probably who can double their earnings over next 4 to 5 years. And that's where you need to focus on to create money out of it,
Okay, all right, Rajesh, noted that, I want to take that chemicals point ahead. But by the way, just need to pull up the intraday chart on the Nifty. It seemed that we were breaking away towards that 17,080 odd mark, but we met with some resistance and now we've seen a quick 40-point downtake. The last 30 minutes are coming up, so let's see whether or not the bulls have got enough fight. But we went to nearly around 17,080, and from there we did see some bit of selling. But Rajesh, you were talking about the chemical space. And GNFC is a stock that has suddenly spiked up. I understand there has been some kind of capacity shutdowns in various parts of Europe, and that's why TDI prices as well have moved up. Any view on the stock in particular? You all have played it otherwise via various other specialty chemicals, but any view on this one or the themes you like in that space?
Basically, this particular name, we do not have any specific comments. We do not own this company. I think what is very important is please differentiate between two sets. One set which is going to benefit because of the rise in commodity prices. So underlying business, if it's a commodity in nature, probably is a temporary phenomenon. The stock may do well, but it might be temporary in nature. And second important bucket is where it is a really business mode. It is a really global cost competitive. Are you going to see that kind of a trend, more approvals from the customer, more offtake from the customers, more participation in the technology collaboration? And that's where the specialty chemical companies, particularly the fluorine-based chemistries I'm talking about, they are getting a significant benefit out of it. And that trend will continue even to the other chemistries apart from fluorine. And I think it is just a beginning. If you ask my personal view, specialty chemical is going to be another at least 5 years plus opportunity. It is going to be a structural theme for 5 to 10 years. So it is a cyclical business, but because China plus one and Europe plus one, and companies have proved their business models and their cost competitiveness, I think it's just a beginning. We are at an inflection point, and we may continue to see, companies doubling their profit, making huge expansion over next 3 to 5 years.
All right, Rajesh, just to counter question you on that. So Naveen Fluorine is something I think that you all have been positive about, right? Besides that, anything you want to disclose with regard to what you have in your portfolio or your clients have it?
Yeah, I mean, whichever companies we have talked about, we might be holding for our PMS clients or personally. So kindly please put that disclaimer.
Defense, Rajesh, is that a space that you find attractive? Because stocks have run out. They've gone through the roof.
Yeah, I think it's going to be a very interesting space, particularly because of the Make in India efforts by Government of India. Again, in this theme, you need to be very, very specific. You need to have a stock-specific approach because if you take a general view that defense is going to do well, it may not so happen. At the end of third year, you may see there are many companies probably they have not got approvals. Ramp-ups delays are always there, being a government-run kind of a programs. Please remember that everything, whatever government approves, then it needs to get tested. So really long gestation projects. So you need to be really stock specific. We own one company, Hindustan Aeronautics, in this space. We like this company. Of course, company has a very strong visibility and company keep getting the new orders in the new segments. If you look at last 3, 6, 9, 12 months, and I think the company is really very well positioned to continue to gain more market share, compared to import to Make in India. So that's one company which we own, but nothing apart from that.
Rajesh, thank you very much for joining in today. By the way, the markets once again have slipped some more. It's back to that 17,000 mark, so things are getting choppy. It's just last 30 minutes to go. Pull up the intraday chart and you would see now the Nifty is once again down more than 120 points. The sell-off on the sensex is close to about 450 points. The banking index, the Nifty Bank, is down nearly 550 points. There has been a very sharp decline in the markets just in the last 10 minutes. I'm not too sure if this is to do with, the 3 p.m. weekly expiry factor, but there has been a very sharp sell-off that you can see in the markets. Quickly to run you through some of the stocks where you can see that, knock coming through. It's, names like, a couple of these HDFC banks. HDFC Bank has come under pressure. HUL has seen a bit of a fall. HDFC Limited is weaker in trade. So some of these stocks is where you can see selling pressure. BPCL has moved to the low point of the day. Infi is also sulking a tad bit. We'll get into a break. When we return, we'll tell you what dealing rooms are telling us. Nimesh will be joining in. But as we get into this break, let's get you some important global opinion that we got from Credit Suisse Dan Feynman, who maintains a cautious stance on the Indian markets amid high interest rates and an appreciating dollar. He's also worried about India's excessive valuation versus its peers.
The problem in the U.S., as everyone knows, the Fed is going to have to be raising rates. We're concerned that markets are still a bit too optimistic about what happens in 2023. I think people are prepared for this year, but we aren't expecting a pivot for the Fed to start cutting rates next year. We think that rates will stay high next year. India, we have some problems. We have a balance of payments challenge. The currency is probably overvalued, but the economy is doing much better than what we will be getting from the U.S. There is EPS risk, but I'd say less than in the U.S. PE of India relative to global equities, relative to Asian equities, all-time high. We're in uncharted territory, and that makes our foreign clients feel uncomfortable. The Fed has already made its last hike. You don't want to wait until markets have made their last EPS cuts. You want to get in maybe 6 months in advance of that. So potentially the bottom for the market could come well before the bottom for EPS or the peaking of rates. Well, I think the dollar will probably retain for some time a bias towards appreciation against major global currencies. The rate differential is only going to get bigger. We're not anticipating enough of a change in policies from the BOJ or the ECB, and especially the BOJ, to stop dollar appreciation against those currencies.
Welcome back. It's time now for our favorite segment, D Street Chatter. Nimesh is joining in to get us an insight into what dealing rooms are saying. Nimesh.
Hi, Rima. So, it's another volatile day of trade, but I guess the street is nervous out of the crucial inflation print which will come tonight in the US. That can set a tone for the Indian markets tomorrow. But the big cue is that the volumes are on the lower side, the flows are muted, as what we saw in the yesterday's trade as well, that the cash flows or the cash commitment was much lower from the both FIs as well as from the DIs. So that's been the trend today as well. I guess from the apart from the macro data and the earnings for within India, I guess the geopolitical risk is something to watch out for, and that can add to the further volatility, at least in the near term. That's the overall feedback. If you see for this week, the Nifty has been ranged between 16,900 on the downside. That's where there is a bit of strong support, and around 17,100 you're seeing a bit of resistance as well. So looks like that's going to be the range and a boundary, so to speak, at least in the near term. But I guess the big takeaway is there is volatility, but the commitment from the larger institutions seems to be missing for the last couple of days.
Okay, and what about individual stocks? What's the buzz that you've picked up?
So in terms of individual names, Rima, the first stock is Mazgao Dog. We've been talking about this stock for the last many days now, and it's been a big outperformer. But now the feedback is some smart HNI investors who have been big holders into Mazgao Dog have started booking some profits at this level. So there is a bit of kind of profit booking from larger HNIs in this particular stock. That's the first one. The second stock is Axis Bank. Again, part of my charter list today, purely on back of strong flows at a leading FI. So it looks like there is a bit of commitment in buying into Axis Bank ahead of the results. Interestingly, CLSA today has also raised the target price to 1100 on Axis Bank. So that's the second one. The third stock is Gujarat Fluoro. It's down. It's under pressure today, down in today's trade. But again, that stock has been a big outperformer in the last couple of months. And the big chatter is that maybe you'll see a large block coming soon in Gujarat Fluoro. So that's the third one. And the last stock is Blue Star, a cash stock, not very high on volumes, but there is a bit of accumulation happening from a larger HNI, from a larger FII for the last many days, and that's been the case today as well. So Blue Star stands out in terms of pure delivery buying in the last many days at a leading FII desk.
Thank you very much, Nimesh, for that. Gujarat Fluoro stock that he was referring to. Today it's down, as he said, 2.2%. But it's up 65% since the start of the year and 90% in the last 1 year. Pull up a one-year chart of the stock, and there you have it. It's been a one-way up move, runaway gains coming through on that. Mitesh Thakkar is now with us to tell us what you can buy today and sell tomorrow, or take a reverse trade. Mitesh, another move down for the markets, not breaching 17,000 or the 200-day moving average, but it suddenly weakened. What have you made of it and the trades?
Yeah, so I think, as I said, I think, the strength is clearly missing, and my bias is that eventually we'll break on the downside. It's only a matter of time once we take out the 6950 and the 200-day area, which is 6980, the 30-point zone. Once that has been taken out, then I think you could see possibly the declining movement catch some kind of momentum on the downside. So till then, I think, trade with cautious, and we have some put spreads on the index while we've had a mix of longs and shorts on the stock side. Right now, I have a sell on Cummins, or rather an STBT. Keep the stock at about 1200, look for targets of 1160 here, and ICICI Bank is the other one which could decline, and that's an STBT with a stop at about 860 for targets of 844.
Okay, all right, Mitesh, got that. Well, Rima, let's come across to you. We got a couple of mid-cap IT companies as well that'll be in focus. We discussed the large cap, but Mindtree and Cyan, both of them report their numbers. What do we expect from them?
Well, Mindtree, very strong revenue growth, and that's going to continue. This quarter, we're working with a dollar revenue growth of 4.3%, constant currency revenue growth closer to 6%, and Mindtree has seen some solid growth over the last 5 or 6 quarters. So strong revenue momentum will continue. Margins will come under pressure owing to the wage hike. The key to track will be retail. The company has a significant exposure to retail versus peers. In the last quarter, the company faced 2 client-specific issues. Is that something which is getting worse? Or what's the outlook on retail? That's going to be tracked very closely. In terms of guidance, 20% plus EBITDA margins. That's what the company had spoken about. Do they maintain it? And secondly, what about their aspiration to deliver industry-leading growth this year? That shouldn't be a problem given how strong their growth is. The other one is Cyient, also post-market as. Big top line number. That's 9.5% in dollar terms. In constant currency terms, it should be a growth of close to about 12%. But this is aided by acquisitions. The organic growth for Cyient is expected to be about 2 to 3%. Margins flat. FY23 revenue as well as margin guidance is likely to be maintained. Here, the attention is more on what happens to the DLM business, design-led manufacturing, DLM. Now, very recently, the board constituted a subcommittee where they were going to explore monetization options, either by way of a part divestment, an IPO, a spin-off, or a partnership with a strategic investor. It probably is in very early stages, but progress on that is going to be very crucial because DLM has not performed for the company, but it still contributes close to about 15% to the top line. So, Nigel, that's the key, more than the numbers, the progress on this DLM business monetization.
Interesting one, Rima. In fact, Cyient, we were chatting with Vineet Sambre, and he was saying that relatively more attractive that stock is in comparison to the remainder of the pack. But let's get in Amrish Palika. He joins in as well. Hi, Amrish. Afternoon. Thanks so much for joining in. Well, we were talking about mid-cap IT companies. Anything from that space that you like before we get to a key pick that you have for us?
Overall, in fact, IT, I see it being weak, at least for the next 2 to 3 quarters. And I suppose that's clearly seen from at least the initial earnings which has come, especially for the large caps. But among the mid-cap IT space, I would clearly have a pick in KPIT as well as Mindtree, which you just spoke about. I think these are the ones which will stand out, possibly showing the best growth. At least over the foreseeable future. So I think when we are talking of IT, there are just about 3 stocks which are possibly, buy and hold, which is TCS, among the large cap, closer to about 3,000, KPIT and Mindtree. HCL Tech, I mean, although it surprised me a bit on the positive, especially the management commentary, but I would just possibly watch it for a while longer before picking it up.
Ambarish, India Cements has been selling off after it sold, its cement business, the part of it. Where does it go from here?
I think this is decently positive because this will, in fact, give them the much-needed cash flow. And I mean, all of us know that there's a very large investor, who's bought about 2 years back into India Cement. And possibly over the next, 18 months or 24 months, we could expect, some sort of a takeover. So I think that's what we should be watching out for. Otherwise, if you're looking at cement pack overall, I think the foreseeable future, the next 3-4 years, due to the sort of infra growth which we are seeing and the sort of consolidation also which we are seeing in that space with Adani buying out Ambuja, ACC, and now JP, I think we should see sort of better valuations going ahead.
Cement, on India Cement, for the last couple of years, the street has been hoping for a change of guard. As you said, maybe in the next couple of years it happens, but it's a little bit of a tricky issue because if you bought the stock 2 days ago, well, you'll be down close to 15 to around 18% odd. But Amrish, what about any other stock from the mid-cap space? Normally, you bring one stock that you would like to talk about. So could you tell us what's on your radar today and give us some rationale for that as well?
My pick today is Godrej Agrovet, one of the largest in the animal feed market in India, with over a million tons of annual sales. And in crop production, they have products to cater to the entire crop life cycle, supported by Aztec Life Sciences, which they bought some time back. That vertical manufactures a wide range of agrochemical active ingredients, in addition to fungicides, insecticides, and herbicides, which have global customers. They are also among the largest in the oil palm developing space, and they've developed over 75,000 hectares of plantations across western and southern states, as well as the northeast. In fact, they will be having a big role in India's focus on achieving self-sufficiency in palm oil. And they also have a smaller foods and dairy vertical, which is a B2C business, which has been growing at about 40% Y-on-Y. So basically a well-diversified company with a good risk balance between the various verticals. Though the stock has underperformed, especially in the last 12 months due to the cost pressures impacting margins, but with softening raw material prices and liquidation of most of the high-cost inventory, I think we should see a much better Q2 and the growth thereafter. In fact, I'm projecting about 12% CAGR for revenue and 18% CAGR for EBITDA over the next 3 years. So I have a price target of about 700 with an EPS expectation of 28 in FY24.
Ambarish, by any chance, do you look at Veranda Learning? They've acquired, the iconic CA classes JK Shah. It's a large deal, closer to, I think, 340 crores thereabout. Did you have a look at this transaction?
No, in fact, I've not really tracked that closely, although, I read about this news flow, but then I don't track it very closely.
Okay. What about Adani Wilmar? The business update looked a bit muted. Is that
exactly?
Yes. So it's not in a similar space as Godrej Agrovet, but it's probably in a broad umbrella. Would you like the stock? What have you made of the update that they've shared?
No, in fact, I've been finding it quite expensive, and although it had moved up due to completely different reasons altogether than the fundamentals, and now in fact it has corrected post the earnings and the commentary, and in fact I would see at least some sort of a pressure on this stock, at least in the foreseeable future, over the next possibly 3 to 4 quarters, 3 to 4 weeks. But then I suppose post that it's again going to be the speculators back in the game. And in fact, we could see it bouncing back. But again, I would say this is not an investor's stock. This is more of a trader's bet.
Got that, Amrish. Well, we have got just 10 minutes to pull down the curtains on today's trading session. It's been a volatile one on expected lines that we're going to play out to weekly expiry. Just 10 minutes to go out there. We'll take our final break. You come back and we'll take you through the final 8-9 minutes of trade. Welcome back. Well, tomorrow we'll have the first big cement company that will be coming out with its numbers, Shree Cement. Incidentally, the stock has moved higher in the last few minutes, but year to date, in fact, it's been a big underperformer. And remember, it's underperformed the Nifty as well, big time in 2022 itself. But the good news is, at least now it's not part of the Nifty. It's been excluded from this month itself. So that's about Shree Cement. The numbers are expected to be rather weak. Remember, valuation-wise, it doesn't have that cushion because it's even more expensive than UltraTech Cement, trading at around 16 times EV on EBITDA. What are the factors at play? Well, revenue is expected to grow by close to around 23%. Operating profit will plunge close to around 35%. Margins will come in at its lowest that we have seen in multiple quarters or multiple years, will come in only at around 15%. And the profit number as well will pull back by close to around 60%. What are the factors at play? I said a 22% growth on the top line. That's going to be led by volumes itself. Close to around 17% growth on the top line on volumes. They will be factoring in some bit of seasonality and also some back-ended recovery in demand. They've commissioned a couple of facilities as well, so that's what helps a good growth on the top line. The remainder of the top line growth will be because of higher realizations. On a year-on-year basis, that should be higher by close to around 5%. Though on a sequential basis, there'll be some pain. The margins will see compression because of two factors. One is higher cost, and the other factor is that realizations have been weaker on a sequential basis. What saves them a little bit is that operating leverage will play out because they sold so much more cement. The key focus, though, will be the management commentary. What's the outlook on demand? What's the outlook on pricing? Capacity addition plans? Is there any inorganic growth that they're looking at? That's something that we'll be waiting by for. Well, Amrish, as I started off by saying that the stock has corrected big time. You know, from the peak of more than 30,000, it's hovering around 21,000 odd. Valuation-wise, it's not cheap though. High pedigree management. Would you look to buy this stock, or do you think there are better opportunities in the cement space?
No, I mean, I would suggest that there are better opportunities. In fact, I mean, I would look at a stock like UltraTech, which I find it decently valued at these levels. And with the market correction, I suppose we could get it about 500, 600 rupees cheaper than where it is right now. So that's one stock which I would surely have. And the other one would be JK Lakshmi, where in fact I see a decent growth coming. So I think these are two picks in the cement space. And post that, possibly I would look at Shree Cement.
What about Bajaj Auto? That's the other one which declares numbers. The auto sales numbers from Bajaj Auto have been muted from the export side. So it's getting hit on account of its export exposure. In terms of Q2 numbers and the outlook, what would you expect?
Exports are getting affected, and when we are looking at the domestic sales, clearly it's the EVs in the two-wheelers which have actually taken off very well. And that's what is going to affect both Hero as well as Bajaj to a larger extent. So, I mean, at this point of time, I wouldn't be a buyer in either of these.
Okay, that you wouldn't be a buyer in Bajaj as well as Hero, but Hero recently launched that EV offering Vida, and it's seen a pretty good response, at least on Twitter and social media. There is a lot of buzz surrounding Vida. Let's just quickly wrap up the market. It's turned out to be an extremely choppy session for our markets. The street is clearly nervous about the crucial inflation print which comes out of the United States. Look at the way the markets have gone down multiple times to test that 17,000 mark, to test that 200-day moving average. The low today was 16,957, which pretty much coincides with the low that the markets hit over the last 2 days. We're defending it, but still, all the attempts to rise and climb above it have been sold into. So as Mitesh has been saying, the markets are finding it difficult to climb higher. There is lack of upward strength in the markets. By the end of it, it's about a 100-point knock coming through on the Nifty as we speak, 0.6% down on the Nifty. The sensex lower by 376. Banks have underperformed today. The Nifty banking index is down close to about more than 1.2%, with selling pressure visible in names like State Bank of India, ICICI Bank, HDFC Bank ahead of its earnings on Saturday. Axis Bank, compared to the rest, has gotten away with a minor cut of just about 0.5%. Nimesh was telling us about how there are buys of HNI at the HNI desk for Axis Bank, and plus that CLSA target price increase to 1100 has also aided. On the big mover side, it's got to be Wipro. Wipro ends with a cut of close to about 7% after the street is disappointed by its performance. HCL Tech, on the other hand, goes home with a gain of nearly 3%. A couple of the other big movers include Sun Pharma, Tata Motors, Eicher Motors. So a couple of these auto names holding up in the green. Britannia as well saw some buying, Nigel.
Well, fair bit of action, actually from the broader markets as well. To run you through a few losers. First, India Cements was down close to 6%. It went back to its losing ways. And the last couple of trading sessions, it's corrected from around 280 all the way to around 235 odd. So it's been a sharp plunge that we've seen out there. Escorts Kubota. Well, that stock as well was down close to around 4.5% in trade today. Indian Hotels was down close to around 4%. And IDBI Bank, well, there were hopes of privatization. Maybe it happens in the next few months. But today, there was some money getting taken off the table. ACC is back below their open offer price, so that stock was down close to around 2.5% in trade. Nalco, that's going to be the clear beneficiary if aluminium prices remain elevated globally because of the supply disruption. Well, that one went up with gains of close to around 3%, while Hindalco gave up almost all of its gains. But there were far, big movers in the broader markets. AB Money, take a look at that stock, up more than 10%. Rights, stock flying away. Penar Industries, they got a new order. That stock was up and about. And dredging, it's had a good last couple of days. The stock was up close to around 10% in trade today. And Liberty Shoes as well. It's lacing up and running away. Religev, the other stock that was up close to 7.5%. So from the broader markets, there were a fair bit of winners. But to wind things down, the Nifty ended with a cut of close to around 100 points in trade today. It threatened to go past that 17,100 odd, but it did see some selling from the top. The Nifty Bank, well, that was an underperformer after being a relative outperformer over the last few days, though it came off the day's low of around 38,500 odd. The breadth of the market in favor of the number of stocks that are declining. 2 stocks declining for 1 stock that was advancing. Well, on that note, it's curtains down on this edition of Closing Bell, but you stay tuned to CNBC TV18. Our special segment on Thursdays, Big Deal, comes up next.